Can you trade equity indices through futures? Did you know that a single E-mini S&P 500 futures contract represents the value of 500 underlying stocks? Or that futures trading volume often dwarfs that of the underlying equities themselves? These facts underscore the immense popularity and significance of equity index futures in the modern financial landscape. Equity index futures are derivative contracts that allow investors to speculate on or hedge their positions in a basket of stocks without purchasing individual shares. By trading futures, investors can gain exposure to the overall market's performance, potentially amplifying both profits and losses. One of the primary advantages of trading equity index futures is leverage. With a relatively small investment, traders can control a large amount of underlying equity value. This can lead to substantial returns, but it also carries significant risks, a small movement in the underlying index. Another benefit of futures trading is liquidity. Equity index futures are among the most liquid financial instruments available, ensuring that traders can easily enter and exit positions. This high liquidity also contributes to price efficiency, as market participants have access to a deep pool of buyers and sellers. However, futures trading is not without its challenges. The leverage that makes futures so attractive can also work against traders. A sudden market downturn can lead to substantial losses, potentially wiping out an entire trading account. Additionally, futures contracts have expiration dates, which means that traders must either roll over their positions into new contracts or close them out before expiration. For investors seeking to speculate on the overall market's direction, equity index futures can be a powerful tool. However, it is essential to understand the risks involved and to develop a sound trading strategy. By carefully considering factors such as leverage, liquidity, and expiration dates, investors can make informed decisions and maximize their potential returns.